Somebody's buying gold and silver down here. Probably a stupid person, right? Okay, like silver back to 100, let's say, or gold
Right.
back to 5,500. That's when the price guys will wake up and say, well, it wasn't a top. Well, momentum levels will trigger way before then. And we've set these beautiful structures. When you see the momentum chart, you'd say, oh boy, what a breakout level pending just overhead. The monetary degradation of major fiat currencies is the ongoing motor under the monetary metals. You've had your 3 shots to break this market down into the $50 level or wherever you think it's going to go, and you failed. Basically, you've had redundant sideways price action for 5.5, 6 months.
Is a $72 price level, is that just a price level, or I guess, is that where your momentum structure?
We're not eightfold. Eightfold would put gold like $8,500, and then you will at least be able to say, oh, gold just had a bull market that matched the 2 prior ones. Ho hum, big deal, okay? And yet we have a global government bond crisis now, something we've never had before. It has monetary waves.
You're targeting $300, $400, $500 silver potentially, this year. It's June, and on this data, obviously silver's selling off a little bit this week. Does a print like this alter your timeline for a breakout, or is this just kind of standard turbulence?
Yeah, the latter. Okay.
Yeah.
I think Fed policy is essentially irrelevant to the major trends in the monetary metals. A lot of people think, if the Fed raises rates, that chokes the gold and silver market and the stock market, et cetera. We'll go back and look at the global, and also recession should suppress metal prices as well, right? Okay. Well, we had a combination of global recession and massive rate rises by the Fed, not just on the short end of the market, but long end bonds, 75 to 1980. Okay. Go back and look at charts then. Gold exploded. It was vertical. Stock market was a total wasteland for a decade, including that time period. Silver had a massive move as well. We all know it went up to $50 during a time of extremely sharp rate rise. And I think they had Fed funds at 14%. Okay, and the long-term bond yields went from 7.5% to 12.5%, and yet gold exploded. So take that notion, and there's other proof of what I'm arguing as well, not just that major incident. But a lot of the assumptions that people operate on are simply true here and there, but not true broadly. And not, if you go back and look through the data and the charts, you'll say, oh, it's a coin toss at best, or not even that good. And so I think you need to ignore the Fed. The Fed is first off, it's not a trend maker, it's a trend chaser.
Markets are drifting lower. Yet the real shock is how confidently investors still lean on Fed narratives that history repeatedly disproves. According to Michael Oliver, major metal cycles have unfolded even under aggressive tightening, including the late 1970s, when rates surged and gold still went vertical. That disconnect forces a hard question. Are rate hikes actually signals, or just noise layered over deeper monetary trends? For portfolios, the danger isn't policy itself, it's misreading it and reacting late. Next, Michael Oliver exposes how institutional timing ignores headlines entirely and positions ahead of structural breaks.
Once the trends changed, for example, the stock market tops and heads down, you go back and look, they cut rates like crazy, 2000 to 2002, 2007 to 2009. Did that help the stock market? Nope. During that time, by the way, gold was going up. It's a contrary to the stock market. But anyway, so I think the Fed is irrelevant.
Yeah. I mean, for the viewer watching today, though, they see silver down more than 6% on a hot jobs report. What do you tell them? Ignore the Fed reaction entirely, or kind of wait for a specific silver level to confirm the structure?
Very good. We always wait for our numbers. And what MSA does is we look at price charts, sure. And let me make a comment on that, too, once I'm finished about price. But what we do is we take price and convert it into momentum trends. And I don't mean the stuff you have on your screen like MACD or RSI, that kind of thing, but structural charts where it looks like a bar chart, just like a price chart, but it's a momentum oscillator where we're measuring the price action of a given market in relation to a certain, preferably long-term moving average. And so, for example, in silver and gold, our last major buy signals on silver We're at 25 bucks back in 2024. And in 2025, in the summer at 35. And our last buy signal was November of last year at 56. And that was it. Those were our last major trigger points. Since then, the major trend has been up in price and in momentum. And the price drop we've seen has not in the least bit damaged the long-term momentum trend of silver or gold. It has damaged intermediate trend structures, things that matter for a few months, several weeks, that kind of thing.
A single red day is being treated like a regime change, even though prior signals already confirmed the larger uptrend months ago. According to Michael Oliver, momentum structure, not headline reactions, has defined every major silver entry point, with key triggers forming well before price extremes. The gap between short-term panic and structural confirmation is where most capital destruction happens. Investors reacting to jobs data are effectively trading noise while ignoring trend architecture. Next, Michael Oliver exposes how multi-month consolidation is quietly setting the stage for the next directional break that most traders will miss.
And so now look at price now. Just forget about my momentum analysis. If you go back to January, we had that collapse literally in one day. The final day of January, 31st, silver collapsed huge and had some follow through into February 3rd, the first trading day of February. So really a day and a half, okay? You collapsed down to a low of $64 silver. Whoosh. You then spent the next several months, now it's into the 6 month, beginning into the 6 month after the January peak, of going up to 90 and failing repeatedly and keep coming down and probing below 70. We had a cleansing puke that occurred in March 23rd. That's when silver and gold both said, hey, let's go down and blow out the price low that occurred in that early February drop and run the sell stops, okay? $64 silver, it went to 61 on March 23rd. Within hours, literally hours, you were back above that 64, and within a week or so, you were $10 off the low. In other words, phooey on your sell stops, phooey on your price chart levels. We ran the stops, big deal. Now we're having a third pullback today, as we speak, where silver's again probed below 70. But think about it this way. If you drew a line sideways from that January collapse, February low, 64 bucks silver. In fact, take it about 10 bucks above that, put it in mid 70s. You could draw a line sideways through the last 5+ months of action, up, down, up, down. And yet the bears think they're winning. They're kissing their sister. They were there in January. Okay. And they keep selling and say we've had 6 months of constant selling pressure and yet no net continued decline, meaning somebody's buying gold and silver down here.
Price looks chaotic on the surface, but the deeper structure reveals a stalled breakdown rather than a trend reversal. What Michael Oliver is highlighting is a market repeatedly flushing stops below $70, while consistently recovering back into the same range, effectively trapping both bulls and bears in rotational noise. That kind of compression rarely resolves quietly. It builds tension beneath perceived stability. For investors, the risk is mistaking sideways volatility for weakness and exiting before expansion. Next, Michael Oliver's structure thesis exposes why this failed breakdown may actually be accumulation in disguise before a directional release.
Probably a stupid person, right? Okay, no. They have a bigger picture of gold and silver than the Iran headline that comes and goes, what the Fed might do or may not do, all that. It's all irrelevant. It's the monetary degradation of major fiat currencies is the ongoing motor under the monetary metals.
So this is interesting. I mean, you're saying that March 23rd was kind of that real stress test. Price puked, stops got run, and then silver quickly reclaimed that level. Is that the template for today too? I mean, if this is the third pullback, is it usually where the trend fails, or is this where the market just finishes shaking people out?
When we run our intermediate trend studies and examine what's happened over the last 5 to 6 months since the January peak and the drops that followed, there's ups and downs, and we plot that, we've built what we call structure overhead, meaning a level that if you ever get through it, you're going to blow the lid off these guys. And that level will occur well before you ever get price up to a level again, like silver back to 100, let's say, or gold
Right.
back to 5,500. That's when the price guys will wake up and say, well, it wasn't a top. Okay. Well, momentum levels will trigger way before then. And we've set these beautiful structures. When you see the momentum chart, you'd say, oh boy, what a breakout level pending just overhead. Right now, I would say this to anybody who's looking at the short-term noise.
Yeah.
Remember, a week ago it looked good, now it looks bad. A week before that it looked good, et cetera, sideways. Right now, we traded down into the 68s today. Okay, I'm going to tell you this: if next week you see it up in the 72 to 74 zone, and you're short, you better cover.
The real signal isn't the price dip, it's the construction of what looks like structure overhead before a breakout event. What Michael Oliver is highlighting is a market compressing beneath resistance levels that institutions already map internally, while retail reacts to each swing. That divergence between short-term perception and pre-planned momentum thresholds is where positioning quietly shifts. If traders are still short into reclaim zones, like 72 to 74, they are effectively leaning against the structure that typically precedes expansion. Next, Michael Oliver exposes how these ignored levels historically precede violent repricing events.
Okay, because you've had your 3 shots to break this market down into the $50 level or wherever you think it's going to go, and you failed. Basically, you've had redundant sideways price action for 5.5, 6 months.
So, I mean, I guess the question is the $72 price level, is that just a price level, or I guess, is that where your momentum structure?
I've got a bunch of trigger levels on different metrics. In other words, like a 3-week average oscillator or a 3-month average. And we also have, when we study momentum, it's not merely the trend structures like trend lines being broken out above or below or ceilings or anything like that. It's also the age. And here we are, if you go back on the monthly oscillator and go back through history of silver or gold or almost any market, and when you see 6 months of downtrending pattern of highs or uptrending pattern of lows on the oscillator, you've got some age there on this intermediate metric, a 3-month average oscillator. This is now month 6 off of the high, January high, February lower high, March, April, May, June. On the oscillator, it continues to descend, and yet after 6 months of pressure, you're still trading where you were. In fact, you're above where you were in that first break. So it's been 6 months of the clock burning for the bears, and they can't seem to get it any lower and sustain it than what they saw on February 3rd.
Trying, Michael. I mean, listen, that's helpful. So for viewers, you're not saying price alone matters. You're saying price only matters once it's measured against the structure. I want to pull up a chart that you kind of specifically asked to discuss today as well. I mean, this is from page 4 of your October report.
6 months of sideways price action is being mistaken for control, yet underlying momentum deterioration suggests something far more unstable beneath the surface. According to Michael Oliver, oscillator age, now stretching across half a year, is historically where markets transition from compression into expansion. That persistence without breakdown is not neutrality, it's pressure building beneath visible calm. Investors treating this as range-bound safety risk, missing the structural exhaustion forming underneath. Next, Michael Oliver exposes how time inside the range becomes the silent trigger for violent repricing.
Tracking silver and gold on long-term monthly log charts. Now, I just want to give some context to the viewer because, I mean, your report argues that gold is repeatedly broken into new, higher price ranges while silver was contained in the same kind of broad range from roughly half a century, right? I mean, at the same time, you wrote that gold was about 4-fold off of its 2015 bear market low compared with prior roughly 8-fold advances. So, I mean, meanwhile, silver only marginally traded above its long-term range. I mean, you kind of concluded that MSA expected silver to unleash, and I quote, unleash into a totally new price reality. So are you saying silver's kind of been mispriced for 50 years?
Yeah, well, if you go back and look, well, first off, the thing you should really look at, the fundamental data point, is an M2 chart. Federal Reserve of St. Louis, go to their site to type in M2. And you can go back and click on a month, like 1975, January, February, March. You could see where the money supply was each month. And do the math between where we were, let's say, in 1980 and where it is now. It's like a 25-fold gain in the money supply. Not 25%, 25-fold, okay? And you look at a gold chart, and remember, people like to talk about silver as an industrial metal, and it is. But it's also money. It has been money for 3,000 years, right alongside of gold. It's been the poor man's gold. But it has an industrial supply-demand deficit now for 5 years in a row, I think. And so you've got a lot of things building under silver. Why has silver, between 1975 and October of last year, when that chart that I sent you was pushing the top of that range?
A 50-year range suddenly looks less like stability and more like suppression when measured against monetary expansion of over 20x in M2 supply. What Michael Oliver is highlighting is a structural disconnect between silver's long-term pricing band and the fiat liquidity environment it exists in. That divergence raises a hard question. Why has gold repriced multiple cycles while silver remained compressed? For portfolios, this isn't theoretical. It implies latent revaluation risk if the historical range breaks. Next, Michael Oliver exposes why this missing adjustment may already be nearing its release point.
$50 ceiling. It had been caught in a range that was a tenfold range from about $4 to $5 on the bottom to 50 for 50 years, half a century, caught in a box. Gold, in each of the bull swings that silver went back to 50, etc., made vastly new highs each time. In fact, when you measure gold from its bare low that preceded any bull market high, like from 1976 was a 50% drop from the 75 high. Start there. 1980 it was an 8-fold gain in gold price. Then you go to 2001 where gold had pulled back and was about 260, actually 256. And by 2011, an 8-fold gain in gold price. Same multiple, same dimension of gain without the kind of fundamentals we have now, which are far more onerous, far more bullish for gold. Now, where's our bear low? It was 1,050 in 2015. We're only 4-fold, 5-fold, okay? We're not 8-fold. 8-fold would put gold like $8,500, and then you will at least be able to say, oh, gold just had a bull market that matched the two prior ones. Ho-hum, big deal, okay? And yet we have a global government bond crisis now, something we've never had before, which has monetary waves. How come silver was caught in the box the whole time, up until October? You can look at a chart of copper and go back to 75 through the present. Copper for multiple decades was 50 cents to $1.50, 50 cents to $1.50. In late 2005, copper punched up above the $1.50 level, and within several quarters reached $4.10 in a vertical surge in several quarters. Multiple decades taken out, several quarters it quadrupled its average price, quintupled above the low.
Commodities don't break decades-long ranges gradually. They snap when liquidity and demand finally overwhelm long-term compression. According to Michael Oliver, gold and copper already escaped multi-decade ranges, while silver lagged behind despite similar macro conditions. That lag creates a timing distortion where one asset reprices while another remains artificially anchored. For investors, the danger is assuming delay means failure, when historically it often precedes acceleration. Next, Michael Oliver exposes why silver's delayed breakup behavior may mirror past explosive catch-up cycles.
And lived in a new reality after that. Instead, copper didn't go back to 50 cents. It basically lived in a $3.50 range. Now it's $6.40. Okay. Now, how come silver, copper wasn't restrained, gold wasn't restrained, heck, lead wasn't restrained. Lead did the same thing copper did. It did it in 2007. What the hell's going on with silver? Well, we know the stories that are out there, and they're not just stories. They're validated. There's been an attempt to suppress the price of silver. Well, obviously those guys failed because last October, silver said, okay, no more. And it produced the first surge in a tantrum. Not the satisfying surge, but the first statement, I'm out of here. I'm going to catch up to old reality, make a new reality, just like copper did, just like gold did. And I think the next, after we come out of this congestion zone, which will be viewed in hindsight as a congestion zone, what's on the other side of that will be far sharper and more vertical than what preceded it.
Right.
And I still think that's going to happen. I have no reason to change that view. It's a matter now of defining when does that upturn occur sufficiently to say, okay, we're coming out of here.
Yeah.
And my numbers are not all that far overhead.
And I mean, to your point, I mean, if they failed in October, why is silver kind of still being hit this hard today? Is it just noise, or are they still able to control the short-term tape?
Well, probably there's some influence there. It could also be that the public buys into the argument that, gee, it's been vertical. Well, when you look at an arithmetic chart, a dollar scale chart, yeah, it looks vertical.
The illusion of continued suppression clashes with repeated historical breakouts across other industrial metals that eventually escaped long consolidation phases. What Michael Oliver's argument suggests is that silver's October move may have marked the first structural breach in a long contained system rather than a finished breakout. That lingering sideways action is therefore less control and more transition friction. For portfolios, misreading congestion as failure risks exiting before expansion resumes. Next, Michael Oliver exposes why perception of vertical exhaustion may actually signal the early stage of a much larger repricing cycle.
Broke out over 50 and went to 120 briefly. And now you're living in a range that's about 50% higher, $75, let's call it, than the old highs. You're still not that far above them on a ratio basis. But when you go back and study like that copper move I told you about, or the lead move, where multiple decades of lead action suddenly broke out, several quarters it quadrupled, okay. Mm-hmm. You put those on a ratio chart, a logarithmic scaled monthly silver chart that I'd sent you, and you take the dimension of that range, which was a tenfold basically, silver, $4, $5 lows to 50, $4 to $5, tenfold range. Add that to the range on a ratio scale, and it says what? $500. Yeah. And if you go back and study the price of silver in relation to the money supply and what gold's done versus the money supply, which is at least match it 25-fold since the 70s, 80s. Silver hasn't. If silver merely caught up to that relationship to the money supply, or caught up to what copper did in late 2005, early 2006, silver would be $500.
Yeah.
Okay. There's other reasons for this 300 to 500 zone, not just those. But anyway, I think we're headed there. I don't see anything but congestion here. And if we'd had this interview a week ago, we'd been looking at upticks. People would be smiling.
Yeah. It's pretty
wild. Like
wild.
every other week. They smile, they frown, they smile, they frown. And yet for 6 months, unless you shorted at $100, you're not making any money really.
Yeah.
It's up and down.
Long-term valuation gaps between silver, gold, and monetary expansion suggest a system still far from equilibrium, even after decades of compression. According to Michael Oliver, silver's failure to match gold's or copper's historical re-rating implies a delayed adjustment rather than a completed cycle. That disconnect frames current volatility as noise inside a much larger repricing corridor. For investors, the implication is stark. Waiting for confirmation may mean chasing a move already underway.